Now let's talk a little bit about the key metrics that you as a limited partner might be interested in. First of all, we have cash on cash. Cash on cash is the net cash flow divided by the equity invested. So if you have $100 total net cash flow and you invested $10 into that deal, you have a 10% cash on cash. The key thing is that cash on cash should be from the net cash flow generated annually. It is not from the refinancing or sale of that property, and it shouldn't be taken from the sale proceeds and then averaged out over the course of the investment timeline. That's not cash on cash. That is, your total return. So you want to look at what is your cash on cash and what are the driving factors. Of course, that's going to be, again, your revenue generated minus all your expenses, including your debt. So it's distinct from net operating income. Net operating income does not include the debt. It only takes into account total revenue generated minus operating expenses at the level of the property, not including the debt. The cash on cash is calculated after all of those expenses, including debt, have been subtracted. And then whatever's left over, that is your net cash flow from the property. And then that is what is going to be distributed to investors. So that is your cash on cash. So that's something you might want to ask. What is the cash on cash from this investment? Now, the next big number you will be interested in is the IRR. That is the internal rate of return. So the internal rate of return is a time-weighted annualized rate of return. So it's taking into account not just your annual return, but when you receive that return, how soon you receive that return. IRR can be manipulated very easily, unfortunately. It's a great tool to compare different investments, and it can be used like ARR or annualized rate of return. If some other investment has an annualized rate of return, you can look at your IRR from this indication and see if it's a better investment. But the IRR is dependent on the exit value or the sale of that property. And of course, as we talked in other modules, we can't really determine the sale price of that property or how much that property will sell for. Obviously, we can project, we can estimate, we can guess based on, what we know about that market, but we can't be sure. So that exit cap rate that we are also guessing to some degree is going to determine that final market value or sales price of that property. And that final sales price or exit value is going to be factored in to the equation for the IRR, and that is what's going to get you your internal rate of return. And the other thing that can impact IRR is the investment timeline. So all things being equal, if you compress the investment timeline, the IRR will go very high. So you can be manipulated very easily. You can take the same deal and say, instead of going 5 years, we're going to complete this deal in 3 years. So IRR is going to look great, but you may not actually make that much more money because it's just compressed. So you have to pay attention to the IRR. If it looks really good, obviously that's wonderful. It's probably a good investment, but we don't know until we look at all the other factors that we are going to be talking about. Just remember that IRR can be easily manipulated by changing the cap rate at exit and therefore the sales price of that property at exit and the timeline, because both of those things are incorporated into this equation for IRR, because it's a time-weighted annualized rate of return. But it's a good tool to decide whether this is a profitable investment. So just keep it in mind with the rest of these different numbers that we're talking about, because you do kind of have to look at all of them together. Now, the next thing you want to look at is the equity multiple. The equity multiple is the total multiple of your invested dollars. So usually it will be stated as a simple number like 1.5 or 2x. That means if you put in $100 and the equity multiple is 2, you should get $200. So it's 2 times whatever you invested. Now, that could be over 10 years, 20 years, 30 years, we don't know, because equity multiple does not take into account the time. It's simply the total multiple of your investment. So you have to kind of look at it with IRR. IRR is giving you like what is the appreciation or growth of that investment annually, and the equity multiple is what is the total profit or return on that investment. So you look at both of them when you're thinking about a particular investment. And the way you calculate equity multiple is by taking all the positive cash flow divided by all the negative cash flow. So essentially all your returns divided by all the money you invested gives you the equity multiple. And not just your initial investment, but if you had any capital calls or extra expenses during that timeline, all of that is going to be added in to ultimately yield your equity multiple. You want to look at all the positive cash flow divided by all the negative cash flows to get your equity multiple, which is the total return on your investment. And when you look at some investment offerings, you'll see that the IRR is really high, but it's because that timeline is really short. And so your equity multiple will actually not be very high. Actually, a lower IRR held for a longer period will yield a much better equity multiple than a shorter timeline with a very high IRR. So just make sure you look at both of those numbers whenever you're evaluating an investment offering. And you have to look at for yourself, are you more interested in that quick appreciation and you want to exit that deal in 1 or 2 years? Or are you looking for long-term growth and you want to double your money? That's going to take a little bit longer. So you want to just decide for yourself, like, what are you in the game for? And of course, if you're interested in more cash flow, you want to look at the cash on cash. So every investor and every investment opportunity is a little different. And you've got to look at it for yourself, like where you are in your journey and where you are in your life. What are your needs? What is your timeline? And if you don't want to be stuck in a project for 5 to 7 years, you may not care about that equity multiple. You'd rather just get the cash on cash, or maybe you'd rather just get some, high IRR, like 30% IRR in a year or two and just get out of it. Just understanding these numbers helps you decide whether this is the right fit for you. Whenever you're looking at an investment offering, you've got to look at what are you interested in? Are you looking for cash flow or are you looking for appreciation? And properties that produce good cash flow are usually very stable, can be held a very long time. They're not going to appreciate very much, but you're going to get steady cash flow. So they'll have a very low IRR, but with a good cash on cash. And usually you'd want to hold these properties for a long time, like 10 years or so. And if you're really interested in that quick appreciation or forced appreciation, as we call it, you'd want to go into a value add multifamily or something that you can increase the value quickly and then get a much higher upside. So you'll have a high IRR, higher equity multiple, but very low cash on cash because you're putting in all that money to renovate the property perhaps or get it up to market rate. So of course that's going to increase your exit value and your sales price, but you're not going to see the money from that sales price until you exit the deal. So you won't have much cash on cash, but hopefully you'll have a really nice equity multiple at the end of that investment. So the other thing you want to look at is the fees. What are the fees charged by the sponsor? Most of the time, standard fees are going to be acquisition fees, asset management fees, disposition fees, sometimes another fee for guaranteeing the loan if it's another GP. Sometimes there's going to be more than one sponsor involved in the general partnership team, and one may be taking on the loan guarantee, and they will charge a percent for that. So that is called a key principal. But the sponsor will generally charge 1% or so to acquire the property. And that is to cover the sponsor's cost in finding that property, doing the due diligence, getting the legal paperwork, zoning, permitting, anything like that is all part of the sponsor's responsibility up front. So that 1% acquisition is to compensate the sponsor for their upfront work in acquiring the property. And then they'll likely charge either 0.5, 1 to 2% per year of the revenue generated from that property for asset management. And that is to just oversee the total asset. Do things need to be repaired? Do we need a new property management team? Are there other, factors that are, whatever's happening to manage that asset? They are in charge of handling that for you as the active sponsor. So it's part of the sponsor's responsibility to manage the asset over the duration of the investment. So they do charge usually 1 to 2% per year of the revenue generated from that property for that asset management fee. And then at disposition, when they sell the property, oftentimes there will be another 1% to sell the property. And this is not including the realtor's fees and or property management company fees. So you have to look at all of these fees and how are they eating into your returns. And so just make sure you're aware of that. If you see, random fees, or they look a little bit high, you should ask the sponsor why, or, what are those for? And they should be able to tell you. And there's generally some industry standards on these fees. And like I said, it's usually 1 to 2%. So that first acquisition fee is off of the purchase price. So it'll be 1% of the purchase price. So obviously that's a big chunk. And then you've got asset management fees are off of the revenue annually. And then the disposition fee will be off of the sales price. So just ask, where is that 1 or 2% coming from? And what is that to cover? And if you see some random fee, like sometimes you'll see a developer's fee or loan guarantee fee or some other fee, you want to just ask. If it looks like it's excessive, just make sure you get clarity on that.